UPS stock, ticker symbol UPS. Is this the best dividend growth stock to buy right now? UPS stock is down 18.5% year to date, which is pretty similar to the S&P 500, which is down 20%. After the earnings were released on the 26th of July, the stock went up roughly 15% because they beat both EPS and revenue. But for the upcoming earnings, 20 analysts expect a miss, so that's very interesting. One of the reasons why investors love UPS stock is because of the dividends. And to me, this is almost a perfect dividend scorecard. But does this mean that UPS stock is the best dividend growth stock to buy right now? In this video, I'm going to show you real quickly what UPS does, the historical returns, the fundamental analysis, dividends, some competitors, and in the last part, I'm giving you my price target to see if they are a buy or not. And I think you definitely want to see that part, so make sure to watch until the end. And I'm also very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So, what does UPS do? As the world's largest parcel delivery company, UPS manages a massive fleet of more than 500 planes and 100,000 vehicles, along with many hundred of sorting facilities, to deliver an average of about 25 million packages per day to residents and business across the globe. If we dive in the latest quarterly report, we see that revenue was up 5.7% year over year, while operating profit was up 8.5%, meaning margins are increasing. In the case of UPS, it increased 40 bps and diluted EPS increased 6.6%. To me, the results are very good since they are still capable of growing versus the lockdown periods, and I really like the fact that margins are increasing as well. UPS reaffirmed the 2022 financial targets, which is something that I really like. Revenue is expected to be around 102 billion, operating margin at 13.7%, return on invested capital above 30%, which is really high, so I do like this a lot, and the share repurchase program raised to 3 billion, which is also very good. I think to keep your eye on is the fact that the average daily volume is decreasing for the business to consumer segment. The business-to-business segment is still growing, but it's also starting to slow down. A thing that I think is very interesting is the RPP, revenue per piece. It's increased 11.9% year over year due to price per gallon and mostly because of the base rates, fuel pricing and mixed improvements. The second half of 2022 outlook is projected to deliver a 5.5% growth for the US domestics with an operating margin of 11.6%. International is expected to deliver a low single digit with a profit margin of 23%. So I would love to see a higher growth number here since this segment has the highest profit margin. Supply chain expects to have a 9 billion revenue with a 10% operating margin. And all combined, the operating margin will be around 13.6%. And now that we know more about UPS and the outlook for the rest of the year, it's time to check the historical returns to see what happened there. I decided to include the S&P 500 as a benchmark, since this is one of the easiest ways to invest. Just buy the S&P 500 ETF and wait. Next to that, I decided to add FedEx, ticker symbol FDX, the biggest competitor for UPS. On the 5-year chart, we see that UPS has the highest return, with 71% including dividends, and beating the S&P 500 by a small margin. The S&P 500 had a 65% return including dividends, and FedEx had a minus 25% return in the past 5 years. On the 1-year chart, we see a minus 5% return for UPS and a minus 11% return for the S&P 500. FedEx had a minus 38% return, so UPS had a negative return on the 1-year chart. But to be honest, it did way better than the S&P 500 and FedEx. On the 6-month chart, we see that UPS delivering a minus 19% return, while the S&P 500 had a minus 40% return. FedEx had a minus 30% return, and please notice the big drop for FedEx, which is in the purple line in this graph. On the 1-month chart, we see a minus 50% return for UPS, while the S&P 500 is at minus 10%. FedEx is at minus 33%. So on the 5-year chart, UPS did better than the S&P 500, but in the past couple of months, the S&P 500 did win. But does this mean that UPS stock is a buy right now? Let's check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe and in return you receive similar analysis to this one every week. Let's continue by diving into the fundamentals. UPS is a 151 billion market cap company, which makes them one of the largest companies in the US, and is the largest parcel delivery company in the world. PE ratio is at 13.9, which could mean that UPS is undervalued. Later in this video we will check the 3 price targets that I created for UPS to see its valuation. Next up is revenue. UPS has a trailing 12-month revenue of 100 billion. And in this graph we see that the revenue has gone up really nice and steady during the lockdown periods. Revenue took a big jump, and after things cooled down, revenue started to slow down to normal levels again. Net income is at 10.9 billion, which gives us a profit margin of 10.9%. And keep in mind that UPS expects to have a 13% margin by the end of the year, so it's increasing even more. The 5-year profit margin is at 7.6%, so they are really doing a great job here. Return on assets is at 7.9%, and to be honest, I would prefer at least 10% here, so keep an eye on this number. Return on equity is at 75%, so this looks good to me. Return on invested capital is at 21%, which is insane high, and I really like this number. The 5-year average is at 10%, so they are doing a great job here. And keep in mind that they expect to have a 30% ROIC by the end of the year, so UPS really knows how to invest the money. Another thing that I really like about UPS is the fact that they are capable of paying down a big chunk of the total debt. Right now, total cash is at 12 billion. Operating cash flow is at 14.8 billion and levered free cash flow is at 7.24 billion. Debt is sitting at 24 billion, meaning they can pay down at least 50% of the total debt. And to me, that's very important for companies this big. But still, it's very important that free cash flow is growing. And to be honest, I would prefer a bit more consistent pattern here. In this graph we see that free cash flow growth over the past couple of years. And it's going up and down quite a lot. But since 2019 it's growing consistently, so keep an eye on this number because it's used to pay down debt of course, buy back shares, do acquisitions, pay dividends and all other things. In this graph we see the shares outstanding. It's going down over a longer period of time, which is a good thing. But during the lockdown periods in 2020 they started to issue new shares, which is something that I don't like. But in the past couple of quarters they started to buy back shares back again. And they also announced a 3 billion share buyback for 2022. So in the end, I think this is still looking good. And it's very important that shares outstanding are decreasing, since this will increase the EPS and of course lower the PE ratio. And in the end, it will be more easier to maintain and increase the dividends. All these things will lead to higher return for the investor. And since we're talking about dividends anyway, UPS pays a 3.5% dividend yield, which is pretty high. Annual payout is at $6.08 a share, or $1.52 per quarter. Payout ratio is at 40%, and to me this is looking really good. I prefer a payout ratio of 50% or lower for companies like UPS, so they are doing a great job here. The 5-year growth rate is at 11%, which is also very good, and this is also because of the big increase recently. They grew the dividends for 12 years in a row, which is pretty impressive. Overall, I think this is an almost perfect dividend scorecard. Dividend yield is high, payout ratio is low, and they are growing the dividends at a decent pace. So from a dividend perspective, I really like UPS. Next up are the fundamentals of UPS versus FedEx, one of the major competitors. UPS is by far the biggest company in market cap and enterprise value. Both companies have a low PE ratio, which kinda makes sense, since people expect lower growth numbers for these two big companies. UPS has an 8% revenue growth year over year, while FedEx has an 11% growth. But UPS has a higher 3 and 5-year revenue compound annual growth rate. The net income compound annual growth rate is higher at FedEx. Both companies have a gross profit margin around 25%, but UPS has a net income margin of 10.9% and it's expected to deliver a 13% margin. So to me, they are the winner here, since FedEx has only 4% income margin. Return on equity, return on assets, and most importantly, return on total capital is higher at UPS. So UPS is definitely the winner here. UPS is capable of paying down at least 50% of all their debt, while FedEx has less cash and way higher debt. So UPS is again the winner here. And now the most important part for a lot of investors, the dividends. UPS has the highest dividend yield, but FedEx has a slightly higher dividend growth rate. UPS has the most consecutive years of dividend increases, so to me UPS is again the winner here. Overall, I think UPS is a better investment based on these fundamentals versus FedEx. But does this mean UPS stock is a buy right now? Let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. Since UPS is the biggest company in the industry and it will be harder to grow at high numbers, I expect revenue to slow down just a little bit. So I'm filling in 4% for the low assumption, 5% for the mid assumption and 6% for the high assumption. For the profit margin, I'm aiming a bit higher, since we saw that margins were increasing a lot, and UPS expects to deliver a 13.7% profit margin for the full year. So I'm filling in 10, 12 and 14%. For the free cash flow margin, I'm aiming just a little bit lower, with 10%, 11% and 12%. For a big company with lower growth multiples, I want to pay a lower PE ratio as well, so I'm filling in 13, 14 and 15. Same story with the price to free cash flow. My desired annual return is 12.5%, since I can get an easy 10% average annual return with owning an ETF. Right now, UPS stock is at $173 a share. I hit analyze, and we do see a lot of green numbers. We have a low price target of $143, a mid price target of $175 to $191, and a high price target of $213 to $249. So if you believe these mid to high numbers, then UPS stock is a buy. But if you believe the low assumption, then UPS stock needs to fall down in stock price. To me, the mid to high range is the most justified here, and I'm aiming for $175 to $230. For now, I'm just waiting a little bit longer to see what's going to happen in the coming days or weeks, because I want a higher margin of safety. So whenever it drops below $165, I think I'm buying this stock. My final conclusion on UPS stock is that I really like the business, but also the stock. Dividends are great, and from a value point of investing, it's almost at my price target by this stock, which is $165. So hopefully it will go down a little bit more, because I really like the most parts of the business, such as revenue growth, free cash flow growth, share buybacks and ROIC, to name a few. For now, I'm waiting for a small drop in stock price, and then I will add UPS to my portfolio. But remember to always do your own research and never fully trust on what I or other YouTubers say about the stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.